two banks, two stocks, one story. And it is the exact same story that has been shredding the private credit world for months. Deutsche Bank and Wells Fargo are getting absolutely hammered right now. Not a routine bad week for two big institutions. Their stocks are getting taken apart in the same way, at the same pace, and for the same underlying reasons as BlackRock, Blackstone, and every other major name at the center of the private credit bust. These are two of the biggest, most globally connected financial institutions on the planet, both designated globally systemically important banks, both watching their valuations get dismantled in full public view, and the market knows exactly why. Because it is the same reason it was always going to be. We said for months that the damage in shadow banking was not going to stay inside shadow banking. The circle was always going to widen. The only question was when, and whose name was going to appear first on the other side of that line. Now we know. Deutsche Bank, Wells Fargo. At the exact same time, the US dollar is making a move that should put every person watching this situation on full alert. The dollar does not lie. When it starts doing what it is doing right now, it is telling you something very specific about what is happening underneath the surface of these markets, and it ties directly into everything that is collapsing in private credit. Jamie Dimon called it the era of doing dumb things. The bill for those dumb things is landing right now on the desks of Deutsche Bank and Wells Fargo, and the dollar is telling you that the people who end up paying that bill are not going to like the number on it. Today we are going through all of it, the Deutsche Bank story, the Wells Fargo story, the dollar, and what it is actually signaling about where this goes next. Who really owns all of this exposure? Why the fund gates are making everything worse rather than better? What 6 months of watching this unfold has actually confirmed? And what the macroeconomic data is now telling us in a way that cannot be explained away anymore. The circle is wider than most people realize. The signals are louder than most people are listening to. The private credit bust is no longer contained inside shadow banking, and the proof is sitting right there in two of the most recognizable bank stock charts in the world. Let us go through every piece of this right now. To understand why Deutsche Bank losing 30% of its market value is such a significant signal, you need the full context. Without the backstory, the magnitude of what is happening does not fully land. Go back to the 2010s. For that entire decade, Deutsche Bank was the institution serious financial analysts pointed to when they wanted a real-world example of a bank that might not make it. Not tabloid fear-mongering, credible, sophisticated people who had deeply studied this bank's derivatives exposure, its capital position, its regulatory situation, and its earnings trajectory. They reached a firm conclusion, most likely candidate for the next Lehman Brothers in global banking. That was the view held about Deutsche Bank for most of a decade. Billions in regulatory fines. Restructuring plan after restructuring plan that never fully delivered. Leadership cycling so fast that any coherent long-term strategy was nearly impossible. For years, the question inside serious financial circles was not whether Deutsche Bank would have a crisis, it was when. Then around 2022 going into 2023, the narrative completely reversed. Costs falling, revenue recovering, balance sheet looking cleaner. Management projecting credibility that previous leadership never established, and the bank moving hard into private credit, which was exactly the trade generating the most enthusiasm in the market at that moment. The stock reflected it. Deutsche Bank shares went on an extraordinary run. People who had spent years waiting for the crisis that never came were calling this a genuine European banking success story, a turnaround that actually worked. Now, we know what was actually driving it. Because starting at the end of January, the stock began moving lower. It has not stopped, down a whopping 30% from that peak, in a matter of weeks. That is not routine sector rotation. That is not a nervous market taking profits. That is the market reaching a verdict, a firm conclusion about what Deutsche Bank is carrying on its balance sheet, what that exposure is worth right now, and what it means for where this institution is headed. When a globally systemically important bank loses 30% of its market value in weeks, the people selling have already decided something is true. They are not speculating about a future risk. They are pricing in a present reality. The verdict on Deutsche Bank's private credit exposure is in. It is not a favorable one. And the same arc is already materializing at the other institution on today's list. Same structure, slightly different timeline, identical underlying story. Wells Fargo is the same story wearing different clothes. If Deutsche Bank was the European bank everyone feared in the 2010s, Wells Fargo was the American bank that could not stop finding new ways to damage itself. The fake account scandal exposed systematic control failures running far deeper than any single product line. The Federal Reserve responded with something it had never done to a major U.S. bank before: an asset cap, a hard ceiling on balance sheet growth. Wells Fargo could not grow past a certain size while every competitor expanded freely and captured market share. That cap sat on the bank for years. Then things appeared to change. The cap was expected to be lifted. Revenue streams were opening. The market rewarded every sign of recovery with enormous enthusiasm. Up until the end of last year, the Wells Fargo rehabilitation story looked like it was working exactly as intended. But now, we can see what the very business decisions the stock market rewarded may actually have been. The same aggressive move into private credit and high-yield lending. The same exposure now turning from an engine into an anchor, tying Wells Fargo directly into the same category as BlackRock, Blackstone, and the rest of the private credit universe under siege. So, you put three things together simultaneously: the dollar, Deutsche Bank, Wells Fargo, and you have the next layer of confirmation that this bust is no longer contained inside shadow banking. Now, the dollar, because the dollar is the signal that ties everything together. The banks are short the dollar. The biggest single short trade in the entire market right now is a bet against the US dollar. The DXY closed at 100 going into the weekend, and when the DXY sits at 100, it historically makes very fast moves toward 102. Not slow and gradual, fast and disorienting. Once that starts, short sellers get chased on the upside. Flight to safety kicks in, everyone short the dollar is running to cover. And once that momentum is moving in one direction, it forces the one thing the private credit world has been working desperately to prevent: price discovery. Price discovery is the two words that explain everything happening underneath all of these developments. It is missing. That absence is the central feature of this bust. Blue Owl's stock is at a record low, and that signal has exhausted itself. The market has already said everything it has to say about Blue Owl. We need the next layer. The dollar is one of those next layer signals. Deutsche Bank and Wells Fargo are two more. All three are saying the same thing simultaneously. A lot of people genuinely did not know who was holding all of this private credit exposure. The initial framing was that it lived primarily with hedge funds and sophisticated investors who consciously chose to reach for yield. That framing made it sound contained, a niche problem in a corner of the market populated by people who knew what they were getting into. Then the banks started acknowledging exposure. Not much, they said. Not really exposed, they said. And not really exposed turned out to mean 30 billion here, 60 billion there. Significant numbers dressed up in qualifying language. Then the insurance companies raised their hands. An 8% yield on an asset stamped with an investment grade rating? That is exactly what an insurance company investment committee is looking for. The actuarial models say you need a certain level of return to fund future claims obligations. Private credit appeared to deliver that return. So, insurance companies bought it, in size. And then the public pension funds, teachers, firefighters, government employees, their retirement savings allocated to private credit in meaningful quantities. The reach for yield was not a niche behavior. It was a system-wide phenomenon that had reached deep into the most conservative, most politically accountable pools of capital in the entire financial system. Banks, insurance companies, pension funds, every type of major institutional capital in the system simultaneously. And the thing that gave all of those buyers the justification they needed is the same thing that made subprime mortgages feel safe before 2008. The rating agencies. AOA rated, of course we bought it. And then JP Morgan came out and said they do not believe these assets are good on the full 100 cents on the dollar. That statement is not a casual opinion from a minor player. JP Morgan is one of the most powerful financial institutions on earth. When JP Morgan publicly questions the valuation of an entire asset class, every institution sitting on these assets has to start asking the question they have been trying very hard not to ask. If JP Morgan does not believe it is 100 cents on the dollar, how much less is it worth? That question does not have a comfortable answer. And the discomfort of not having a comfortable answer is exactly what drives the withdrawal requests. Investors do not need to know the precise discount. They just need to know the stated value is uncertain. That uncertainty alone is enough to make them want out before the uncertainty resolves in the wrong direction, which is when the gates start shutting, which is always the biggest sign that a real problem has arrived. The decisions these funds are making to gate redemptions are not coming from a position of strength. They are being made because gating is the least catastrophic option available. Here is the logic. If you allow withdrawals to proceed freely, you have to sell assets to fund them. Selling private credit assets in the current environment means accepting prices far below what you have them marked at on your books. The buyers who will step in are not paying book value. They are paying what the market thinks these assets are worth right now, which is substantially less. And every distressed sale becomes a public reference price for every similar asset in every similar fund everywhere. Honoring redemptions does not just damage your fund. It destroys the entire sector's ability to maintain its stated valuations simultaneously. So, you gate. You tell investors their redemptions are on hold. You buy time. You hope conditions improve. But gating has a second-order effect that is tearing through this space. When Blue Owl gated several weeks ago, the reaction across the rest of the private credit universe was not relief. It was panic. Every investor in every fund that had not yet gated immediately understood. Get your money out now before your fund does the same. That triggered a wave of withdrawal requests that forced more funds to gate, which sent the same signal again, louder. We said the moment Blue Owl gated, it was going to trigger exactly this cascade. It did. BlackRock gated. Cliffwater, a substantial alternative asset manager most people had never heard of, gated. Morgan Stanley gated. Fund after fund, name after name. The list kept growing. It starts to look like a bank run. Not a traditional bank run at a deposit institution, a shadow bank run. Same fear, same self-reinforcing logic. Every fund manager in this situation has three options, none of them good. Path 1, honor redemptions. Sell assets at distressed prices, but every distressed sale becomes a public reference price that makes every other fund's situation worse. Path 1 is contagion by design. Path 2, gate. But every gate triggers the cascade we just described. Path 3, borrow. Get a credit line from a bank. Use that money to pay back investors without selling the portfolio. No forced sales, no price discovery. Buy time for conditions to improve. This is the path many funds chose when this started in late August and September. That is 6 months ago. 6 months. And the situation has not improved. It has gotten worse at every step, which means path 3 is running out of road. And right now, the dollar and Deutsche Bank are removing what is left of it. There is a version of this story where the villain is a cynical Wall Street firm selling bad products to naive investors. That version is incomplete. The more important version is about institutional hubris. Understanding it tells you why this exact pattern appears in every single major credit cycle throughout history. The pension fund managers who bought this product in size are not naive. They are experienced professionals with sophisticated analytical teams and years of credit market expertise. The insurance company investment committees that approved these allocations understood risk management, and they convinced themselves that their sophistication was what separated them from everyone else. The logic went, yes, there are risks in private credit, but we are institutional investors. We have the tools to distinguish quality assets from problematic ones. We have the staying power to hold through short-term volatility. We are not what Wall Street calls dumb money. Our analytical capability is our protection. That is hubris. The same hubris displayed by institutional investors in every major credit cycle throughout history. The models get more sophisticated, the language gets more elaborate, but the underlying behavior never changes. Buying what everyone else is buying because the yield is attractive and the ratings are good, and the volume of institutional buying itself serves as validation. And beyond hubris, career pressure. If your institutional peers are generating 8% yields from private credit, and you are generating 2% from safer assets, you are not going to be at that job very much longer. Your board wants to know why your competitors are outperforming you by 6 percentage points. The answer that you thought the risk was too high is not an answer that keeps you employed, so you buy it. You write the memo that justifies it in sophisticated language. You build the model showing the downside is manageable. And you do all of that knowing somewhere in your professional judgment that the yield is high precisely because the risk is real. But by the time every institutional investor in the market is buying the same thing, not buying it becomes the greater career risk. That is the herd mentality that every financial bubble requires to reach full scale. It is rational behavior given a bad set of incentives, and it always ends exactly the same way. Private credit was never supposed to go wrong because at the start of last year, the economy was supposed to boom, lend against inventory and receivables. It is all going to move through the system. Everybody gets paid. But now the inventory is not moving. The economy is slowing, the consumer is stretched, and that inventory is going to sit there until somebody has to write it down. Let us go through the macroeconomic picture specifically because the numbers are not giving the optimists much to work with right now. Canadian payrolls just came in at the worst reading since January 2022. One of BMO's economists called it one of the worst monthly results Canada has seen outside of the pandemic lockdown periods. That is not a routine miss. Canada is a significant economy whose financial conditions connect directly into North American credit markets. When a senior bank economist calls the employment number one of the worst on record, you pay attention. In the United States, 5 of the last 9 months of establishment survey payroll reports have been negative. 5 out of 9. The entire argument against taking this credit situation seriously was always grounded in employment. Jobs are being created. Consumer is fine. Businesses generate revenue. Loans get repaid. Everything is okay. That was the framework holding the entire optimist narrative together. The first negative payroll report was a bomb. Not because the raw job losses were catastrophic by themselves, because it shattered the framework. The one data point everyone had been pointing to as proof the economic narrative was still intact went negative. Everyone said, one-time factor, seasonal adjustment. Then it went negative again, and again. Each time explained away, until you have 5 negative months out of 9 and the explanations have run out. Hours worked are stagnant right now. That indicator does not get enough attention. When employers get nervous, the first cut is not headcount. Layoffs are expensive. The first cut is hours. Overtime disappears. Workers shift from full-time to part-time. Hours worked decline before the headline payroll numbers turn dramatically worse. Hours worked going nowhere. Right now is an early read on what future payroll reports may look like. Now, add oil prices moving higher. The consumer who is already financially stretched, already cutting back on discretionary spending, already showing up in surveys as increasingly stressed, now also faces higher energy costs. More dollars going to gasoline and heating means fewer dollars going to the consumer goods and services that businesses borrowed against. It is a direct compression of the spending that those private credit loans were underwritten against. Higher oil also feeds into business operating costs. Transportation rises, production rises. Businesses that cannot pass those higher costs on to a consumer already at the limit see margins compress and cash flows weaken, which means the loans that looked serviceable 6 months ago when oil was lower and the consumer was still spending now look considerably less so. The assets backing those loans are worth less, and everybody sitting on those assets knows it. Deutsche Bank announced this week they are revaluing collateral. That sounds like a technical banking procedure. The consequences are enormous, and they go well beyond Deutsche Bank itself. Deutsche Bank is a major dealer bank. One of its core functions is lending to other financial institutions against collateral. When Deutsche Bank revalues that collateral downward, they are telling the borrower, the assets you pledged to secure this loan are worth less than we said when we made the loan. You need to post additional collateral or pay down the principal. For any fund manager who has been surviving this situation using Path 3, borrowed money from the banks, receiving that message from Deutsche Bank is potentially the end of the road. It eliminates the strategy that has been buying time for 6 months. It forces either additional gating or actual asset sales at distressed prices, and it does not stay contained to the one relationship. When one major dealer bank tightens its collateral standards, the others watch. They take note. And they begin asking the same questions about their own books. This is exactly how a credit crisis migrates from shadow banking into regular banking, not through one dramatic event. Through a sequence of collateral revaluations and lending standard increases that accumulate over months. Deutsche Bank revaluing collateral is not just news about Deutsche Bank. It is a signal about where the entire credit tightening cycle has arrived. And the dollar is both causing and reflecting this process simultaneously. The reason people are suddenly deciding they want to hold dollars after weeks of talking about the dollar going to zero is the same reason people compete for collateral in a stress situation. They are afraid. They are hedging against things going wrong. And when financial conditions tighten, when the dollar shoots higher, it removes the credit availability that Path 3 depends on. Banks respond to this in a very predictable way. They tighten lending standards, they get selective about who they will lend to and what collateral they will accept. And we saw exactly that this week with Deutsche Bank. The DXY at 100 matters because at 100 the dollar tends to make fast moves toward 102, not gradual, fast. If that move happens and holds, every fund manager still relying on borrowed money to manage through this situation faces the same conversation Deutsche Bank just had with its borrowers. The credit line that was keeping you alive just got significantly more complicated. Path 3 is disappearing. Path 1 and Path 2 are what remain. Both paths lead somewhere painful. The question now is not whether the reckoning comes. The question is how fast and how wide. People have been pointing to the broad stock market throughout all of this as evidence that the situation cannot be that serious. If the equity market is holding up, how bad can it really be? That question has been used to dismiss every signal we have been tracking for 6 months. The stock market is not a leading indicator. It is a lagging indicator. It does not tell you what is coming. It catches up to what has already happened. Major downturns do not arrive ahead of the deterioration they eventually reflect. They arrive after the deterioration has been building long enough that it can no longer be rationalized away. Look at Deutsche Bank's stock. Look at Wells Fargo's stock. These equities are giving you real-time price discovery on what the market thinks those institutions are worth today, based on what they are known to be carrying. Deutsche Bank down 30% is the market saying, "We have done our analysis on this bank's private credit exposure, and we believe the bank is worth 30% less than it was at the peak." That is not speculation about a future risk. That is a current assessment of a present reality. If the next payroll report comes in negative and the weekly claims data does not rule that out, you may see the broader equity market begin to close the gap between where it is priced and what the dollar, the bank stocks, and the private credit markets have already been signaling for months. When the equity market plays catch up to a credit crisis, the move tends to be fast and concentrated. Step back and look at the full picture. What is unfolding is a credit cycle bust, not a replica of 2008. The instruments are different, the timeline is different, but the fundamental dynamic is identical to every major credit crisis in history. Private credit is structured to resist price discovery. The repricing happens through indirect signals, gates, write-downs, collateral revaluations, bank stock movements. That makes it slower. It gives the optimists material to work with at every stage. But slower does not mean less serious. Deutsche Bank and Wells Fargo joining the list is not the end of this story. It is the next chapter. The chapter after that is being written right now in the payroll data, the consumer spending numbers, the oil price, the collateral decisions at major dealer banks, and the dollar's move toward 102. All of it is pointing in the same direction. What these institutions thought they had is not what they actually have. That truth has been revealing itself for 6 months. Gate by gate, write down by write down, bank stock decline by bank stock decline. Do not let the broad market tell you the leading indicators were wrong. They were not wrong. They were just early. Thank you for watching. Take care.